Hey friends, I still remember the day that I bought this stock. Seriously, it was over 10 years ago, but I remember the day vividly in my mind because I was sitting at a meeting at work. It wasn't really a fun day. I just remember kind of crunching the numbers and trying to multitask and thinking about this stock while I was dreaming of a better future, if you will, dreaming of what could be in my life if I took the steps to actually invest in this particular stock. Thank goodness my dreams came to fruition with this one. It's only yielding right now 1.66%, but my simple first tranche yield on cost is 6.03%. That's because I purchased this stock way back over 10 years ago, and it's done really well. They've grown the dividend over time pretty aggressively, and I have experienced equity share price appreciation as well that has been just staggering. I want to cover this stock today. It is Caterpillar. That's the one. And the reason I want to cover this stock is because I'm up quite a bit on it. Yes, my yield on cost is high, but the current yield is very low. And sometimes I get questions from the community on this topic. Sometimes I question myself on this topic. In some ways, I'm still like the PPC Ian of 10 plus years ago, where I was sitting in that meeting room. I was kind of dreaming of what the future could be. Life is really great these days, but I've always have dreams. I always have aspirations of creating an even better life. And those dreams, those aspirations, usually they hinge on the success, the cash flow from my dividend stock portfolio. And so I think of this question that so many of you ask me all the time, Ian, should you take this stock? It's Caterpillar, by the way, ticker CAT. Ian, should you take this stock after it's run up so much? The current yield is really low. Sell it. Pay the taxes, redeploy the money into a higher yielder, a stock like Pfizer, for example, that's now yielding about 6%. And I'll link in my pinned comment below to a video that I recently published on Pfizer, because that is a stock right now that I'm actively accumulating in 2024. And I know it's a controversial one, and so I'm leaving the controversy out of it, though I'm just looking at the numbers on that one. But I get this question, and I think about this question because, yes, I've made a lot of money on this stock. I've made a lot of money in the sense that it's run up and my yield on cost is good, but I've got a lot of equity tied up in Caterpillar, so much that if I just take that equity, I pay the taxes on the capital gains, and then I go ahead and redeploy it into a higher yielder, instantly I could drive more cash flow in my personal dividend stock portfolio. And instantly I could start getting closer to those dreams that I daydream about. That is the topic of the video today, everyone. Get ready for a really exciting dividend stock investing video. Welcome to PPC Ian. This is dividend stock investing for everyone. All right, everyone, I only have 2 slides to cover today. The first one, as you can see on the screen in front of you right now, is a real simple one. This highlights the metrics from Caterpillar from their recent press release that covers their 2023 performance. As you can see, it's records across the board. Record. Wow. As a shareholder, I like to see slides like this because it just shows how well this company was doing. And mind you, there were some tough times in recent years, 2019 through 2021. The dividend was really slow to increase. It was kind of paused for a little bit. They weren't increasing it on the normal cadence. And of course, that was during the pandemic. And so a lot of shareholders like myself, we had to stick it through both the good times and the not so good times like 2019 through 2021. But when you see numbers like this, results like this, it is really encouraging. And so the second slide that I want to share with all of you today, as you can see on the screen, is kind of my one and done slide. It has all the things I want to discuss with all of you today. And so as you can see with Caterpillar, I'm just going to go through a few metrics. It's trading at 300 $12.84, even after the stock market sell-off today. And it's only down 6.5% from the 52-week high. In terms of EPS estimates, it's 21 this year, 22 next year. You can kind of see that a forward PE basis, it's still not so bad, even though this thing has run up. And you can clearly see that based on the stock chart on the bottom of the screen, up and to the right over time, although there have been some periods of setbacks as well. Even so, the PE, it's still only in the 14s. Now, first and foremost, I'm not a buyer of Caterpillar here, and a PE of 14, yes, it looks good in theory, but when I see a slide that says record, 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 and I know the history of this company, I understand the company, I realize this is a cyclical business. There are booms and busts when it comes to the construction industry, when it comes to the global macro economy. This company will do great in times of construction boom. It will not do so well in times of construction bust. And so honestly, that PE ratios that I was sharing based on forward estimates, and also just looking at the PE based on their estimates last year in 2023, seeing a PE kind of in that 14s range, it's enticing, but I also understand that this is actually the kind of company oftentimes I'd like to buy when the stock has tanked, the performance is bad, and even the PE might be really high, and then enjoy those times as a buying opportunity. So certainly I'm not buying here because I understand it's a cyclical business, but let's keep going. As you can see on the screen in front of you right now, I have a lot to cover. And so based on the dividend per quarter of $1.30, it's now yielding, as I mentioned, only 1.66%. But they could probably raise that, increase that quite a bit because the payout ratio is now less than 25%. They're being really conservative on the payout ratio. And I think they're doing that because they realize they work in a cyclical industry, in a cyclical business model. And so over long periods of time, it's clearly up and to the right, but there are cyclical setbacks. And so, yes, the payout ratio is a little bit lower. That being said, over the last 5 years, on average, they are increasing the dividend by 8.6% per year on average. That's why I highlighted it. Market cap is $160 billion. I also highlight some stuff there from my first tranche. And so first tranche, I bought at $86 and change in 2013. Just on the equity alone, I have earned a profit of 263%. And so this is really the foundation of the video today. I have profited 263% on this stock. And so the question becomes, Ian, option one, hold on to this thing, let it ride. Option two, sell this thing, sell it, take the capital, redeploy it elsewhere. It's really oftentimes a question that I get from the community and that I ask myself when I own a position that has gone up so much and that has such a low current dividend yield. Because yield on cost is amazing, but I can instantly unlock more cash flow if I were to redeploy the funds in a higher yielder. And so that's why. It's because I'm up so much. But let's keep going. As you can see on the screen in front of you right now, a few more metrics from my first tranche. And a lot of my tranches were actually at this level or lower because after I bought it in 2013, when it went into 2014 and 15, it actually dipped and I kept buying. And so a fun metric that a lot of people don't look at, but that I do, is the PE ratio on cost. And so this really illustrates, I would say, the power of long-term dividend stock investing. As I had already mentioned, the PE ratio right now on a forward basis, it's in the 14s, which is interesting. It's compelling. Like I said, I'm not buying because it's cyclical. But if I look back at my purchase price of $86 and I take that price and I divide by the earnings for 2024, the estimated earnings, I get a PE on cost of 4.06. If I do the same for 2025, if the analysts are accurate in their predictions, I have a PE on cost under 4. This metric is so enticing because it shows how investors who invest in quality companies, in great companies, in dividend growth stocks that live up to their promise over long periods of time, it goes to show how the investment gets de-risked over time. I have very little risk on my first tranche because my forward PE ratio on cost, it's in the 4s, maybe even as low as the 3s. Now, an important note for all of you, I am sharing today a winner, an absolute winner in my portfolio. Are all of my stock selections like this? No. Are all of my investments perfect winners? No, of course not. I am human. I am like anyone else watching the channel today. I'm sharing my journey for fun and entertainment here on YouTube, so all of you can see how I evolve as an investor over time. But I have cherry-picked one of my best performers, which allocates about 2% of the value of my portfolio for the video today, because I want to answer this question, and because I was asking myself this question just recently, if I should sell the thing. That's why I picked this stock. But let's keep going. As you can see on the screen in front of you right now, I want to share the simple yield on cost. And so this does not include reinvested dividends. In the early years, I was reinvesting dividends on this. In recent years, I'm not. I'm using this dividend from this stock, especially now, because I see that it's at kind of full valuation. Do I really want to reinvest at these levels? No, I'm using the dividends right now to help pay bills. But anyway, if I take the dividends per year, which is $5.20, and I divide by my first tranche purchase price of $86.17, that's how I get the 6.03%. Honestly, if they had a 50% payout ratio like many of the dividend stocks that I have, this simple yield on cost, it would be even higher. It would be like 12%. And so this is a very safe dividend with this level of payout ratio, in my opinion. Now, I want to show the dividend history on the right-hand side of the screen. You can see it has grown really well over time. Technically, they're a dividend aristocrat because they have kept increasing the dividend annually over time. But you can see during the pandemic that usually when they used to increase this thing every year, they really paused it and they kind of timed the system to make sure they could show that they're still an aristocrat by growing the dividend when you sum up all the dividends from any given year. But you can see during 19, 20, and 21, the cadence of dividend growth slowed down. You can see that it stood at that $1.03 level for quite some time. And so this is a perfect illustration that any dividend stock, even a monster dividend stock like Caterpillar, it can face tough times. Business is not linear. Business is not always up and to the right. And shareholders who own for long periods of time, like myself, who own for 10 plus years, sometimes there are these kind of periods where it's tougher. And what I've found in my experience, as long as I like the fundamentals of a business and I still have my conviction, is I hold on to these stocks even during tough times. And I think that's an important trait of a successful dividend investor, of an investor that does well. There is no easy way to do this. There is no kind of, oh, it's so easy, I'm going to own this. No, when an investor owns individual stocks, any individual stocks, there are ups and downs. And I stood with this company through tough times, so I can now enjoy the good times. Now, I want to share some thoughts, a summary, if you will, from the video today. And so as you can see on the screen here, I have a summary of them, the takeaways on the bottom. There are 5 of them. But what I want to start with is just kind of philosophy. Overall, where I'm at in my life right now, in my early 40s, I'm still at a place where I can work, I can put in the hours, I'm on my grind, and I'm letting my winners run. And so when I look at options 1 and option 2 here, right now, at least with Caterpillar, this is a clear winner in the portfolio. I'm going to let it run. That's been an overarching philosophy in my investing, is I don't like to cut winners if I don't have to cut winners. There are rare exceptions, of course. There's always rare exceptions. But if I don't need capital for some major purpose at any given time, and I'm really trying not to ever sell a dividend stock ever again, and boy, I don't want to cut my winners, because I think Caterpillar could continue to be a huge winner and offer huge yield on cost over time. Boy, at some point, if they get that payout ratio up higher, say to 40, 50%, I could be yielding 10% on cost on a simple basis, not even including those dividends I reinvested in the early years. Now, I'm going to add a caveat to that. Life changes. Life throws curveballs, a lot of curveballs. If for some reason I was placed in a financial situation where I needed to increase cash flow overnight, instantaneously, I would probably have a contingency plan here where yes, this is a stock on my list that I could sell. And if I had to sell it, I would redeploy funds into something that had a higher but reasonably safe yield. Realty Income and Pfizer are two stocks that come to mind right now that are favorites of mine in 2024. They're yielding more in that 5 to 6% range, where I could unlock more cash flow for myself overnight. And so as a dividend investor, it's important for me to remember that yes, I have these values, these core beliefs, like I don't cut winners, but I also live in reality where I know life changes and I like to have a contingency plan. And so I have a few more takeaways. As you can see on the screen there, I print all of them at the bottom on my single slide from today. But the third one I already covered. It accompanies really that chart on the right-hand side of the screen, that there are times with lower dividend growth. There are times when even quality companies like Caterpillar can be challenged. Business is not linear. There's going to be good and bad times. It's really, really important to remember this. It's important to remember this because so many times on this channel, when I bring a stock forth that is facing bad times, you can see in the comments, and gosh, I love the comments. I'm so excited to be back here doing this video. I can't wait to see you in the comments below. But it's so fun to look at the comments because on a day like today where I highlight a stock like Caterpillar, it's rare I'm going to get too many negative comments about Caterpillar. But on the day I talk about a stock that's under a little bit of pressure, I'm not going to keep picking on Pfizer. So maybe this time I'm going to pick on Realty Income. It's facing a little bit of pressure lately because of interest rates. You get more of a mixed bag of comments, if you will. You'll get some commentators saying, yeah, I love it. I like it like you. I see the value. But there's others that are fearful. They're like, look, times are bad at this company, but they're only going to get worse. And so it's hard to buy into the value. It's hard to stick with a stock that is of quality when value prices or hard times come about, because that's human nature. And so it's so important to realize that, because one of the hardest parts of this game of dividend investing, it's not just selecting stocks, it's having the willpower to stick with it through hard times. And it's having the intuition in the hard times to understand what is really a failing business versus a great business that's having a temporary setback. And that's a nuanced skill. I'm not going to say I'm perfect at it, but you develop it. I developed it over time. It's a skill that keeps improving over time. But I have a few more thoughts that I want to share today before we close out. As you can see on the screen, putting it there more to remind myself than you, just so I can look at this for a minute. But I'd love to say here, takeaway number 4, that long-term dividend growth investing, it just takes patience. And this really ties into the last point about holding on. I've seen with a lot of my stocks that the magic, it really starts happening after I've held for a decade. And so this is a perfect example that I can have this video today. I can be so excited. It's so easy right now because I put in the time, I put in the hard work. I'll give you another analogy. My wife and I now, we're in F45, which is a fitness class, a fitness facility. We love it. I've been putting in the hard work. My wife has been putting in the hard work to get fit and to gain muscle, to develop muscle. And you just have to put in the hard work. It is painful. It is hard. It involves willpower. But after a certain point, the work never really gets easier, but at least you see the results. And so it's the same kind of thing here with dividend stock investing, that I put in the hard work. I put in the 10 plus years of Caterpillar. Now I can rest a little easier with this one. But I want to go all the way back in thought number 5 to the day I bought this darn thing. And I want this to serve as a reminder to this entire community, because so many of you out there, you're striving for financial freedom, or you're striving just for a better life, for some more balance in your life, for a life that maybe it's not all worrying about your job or worrying so much, oh, is my boss going to come into the job and is it going to be a tough day, or is my boss going to argue with me about this or that? Trying to have a more balanced, a better life for yourself and your family. Honestly, that's exactly what I was thinking the day that I bought this. I remember the day. I remember where I was sitting. I remember where I was thinking about when I bought this stock. And I like to remember these moments. I also remember other moments. I remember when I started my YouTube channel, and put in the comments below if you were around when I used to do those videos in my backyard. I remember those days where it was sunny out, the weather was good, I felt good. I felt like, wow, I'm really doing something here that is adding value out there on the internet for people that don't know about dividends. And I remember those kinds of days too. And I remember them vividly. And I remember just how much fun I had, which is one of the reasons I'm doing the video today. I got to get back in this routine because I love this. I love all of you. And I just want all of you at home to celebrate over long periods of time those hard days, but also the good days too, and to remember them. Remember those milestones in your journey, and to remember that the purpose of all of this is to plant the seeds so that life eventually will get better. You can dream about a better future for yourself and for your family. And the journey just keeps on continuing. All right, everyone, if you enjoyed the video today, please go ahead and click the like button. It really always does mean the world to me. And don't forget to subscribe as well. And I'll see you in the comments. Before I go, in terms of a friendly disclaimer, today's video, it's not investment advice. I'm not a licensed investment advisor. I'm just sharing my journey here on YouTube for fun and entertainment. It's possible to lose money in the stock market, and I'm just sharing my journey here for fun and entertainment. I'm not a licensed advisor. Also, in terms of a full disclosure, I'm long Caterpillar, ticker CAT. I'm long Pfizer, ticker PFE. I'm long Realty Income, ticker O. I own those stocks in my personal dividend stock portfolio. Thank you for watching. I will see you in the next video.